Hello and welcome to today's webinar, Collateral Optimization Strategies under the new IOSCO Margin Regulations, hosted by Asia Risk in association with Calypso Technology. My name is Aaron Walner and I'm the editor of Asia Risk. In the initial stages of the post-GFC reform of the OTC markets, regulators focused on moving derivatives onto central clearinghouses and setting up the related regulatory and electronic trading frameworks. All the major IRS markets in the US, Europe, Japan and Australia are a relatively advanced stage in this process. Attention subsequently switched to the slightly thornier question of how to deal with instruments which are not easily cleared and as such would remain bilaterally focused markets. In 2013, BCBS IOSCO published its original proposals, which were reviewed on March 18 this year, which delayed the implementation of both initial and variation margin by 9 months and introduced a phase and arrangement for variation margin. The lack of global margin calculation standards, however, means that despite this delay, derivative users are still in the dark over the exact impact of the move to margining non-clear derivatives will have on the use of collateral in their businesses and the possible knock-on effect on pricing. So I'm fortunate to have a very experienced panel with me today to shed some light on the exact nature of these proposals and how best to deal with them. On the banking side, I have with me here in Hong Kong, Odell Burke, who's head of product for APAC Collateral Management at JP Morgan. And next is a fellow Hong Kong resident, Karim Shaban, who's also head of product for APAC Collateral Management, for this time at Citi. Dialing in from Australia is John Feeney, who's head of pricing for National Australia Bank. While based in London and giving us the tech solution provider angle on this issue is David Little, Director of Strategy and Business Development for Calypso Technologies. Our final panelist is Nick Horn, Manager in the Compliance and Risk Management Department at QIC in Brisbane. We've got a lot to get through in the next 60 minutes, but before we start, I just want to explain a little bit about the format. Intervals throughout the conversation, we will conduct polling questions from you, the audience. I'll explain how those work at the time, but the real key point I'd like to make is the panelists are very keen to hear on your views and get direct questions from the audience. If at any point you have a question for all or one of the panelists, please click the Ask Question button on the attendee panel part of the dial-in function and send a message, the question across, and we'll try and get those to the panelists and get a response. The webinar will also be recorded and will be available online permanently from within, I think, a couple of hours of the webinar itself finishing. So without further ado, I'd like to start today's discussion. I'd like to start with Odell. It's just before we go into some of the details over some of the implications, perhaps you could give us a background about what's happened, what's the background to these proposals and what the changes have been made, and perhaps give us some context to the following discussion.
Yeah. Thanks for that, Aaron. So in terms of just setting the context as far as this particular change, with respect to non-centrally cleared derivative and the requirement that those trading arrangements should have a proper sort of margin process around that. The impetus of this started off, of course, the 2009 G20 commitment. This was the fourth element in terms of, the three commitments that come before. The first was to do with the standardization of OTC derivatives such that they can clear through exchange. The second was to do with the fact that you will have CCPs that would be responsible for clearing these type of standardized OTC derivative. The third element was to do with more from a reporting perspective where we would have trade repository. So now we're on the fourth element, which has to do with the margin arrangement for the non-centrally cleared derivatives. I guess in terms of change as far as managing this arrangement, I think the first major change in terms of what has been traditionally the practice in the market and the direction that we're going now is around the departure from this being a discretionary activity. In the past, the posting of margin and the margin that was posted at that time for OTC derivative was just basically variation margin. With what we're looking at in terms of moving forward, not only you will have a variation margin, but you have the introduction of initial margin. So this is a departure in terms of what was the traditional practice in terms of your traditional buy-side or sell-side clients trading these products. The other major change just in the derivatives space is the bifurcation of the portfolio, if you will. So before, you basically had, the ubiquitous OTC derivative portfolio would, of course, differ by the different types of contracts that might be in a given portfolio. Now that portfolio is split between cleared versus non-cleared. So in terms of from a liquidity perspective, when you look at it from a collateral perspective, you have to now think holistically across those two trade buckets, in addition to other trading activities that you would have, like, for example, repo trading or stock loan or securities lending trading. As long as you have other type of secure type of activities taking place, you need to think how you're going to utilize your inventory pool as far as collateral across all these trading arrangements. So those are some examples of areas that have impacted the traditional way in terms of OTC derivatives, and the fact that now we have the introduction of margin requirements for the non-cleared derivatives.
Okay, thank you, Odell. So just kind of bringing on, there's been some quite practical implications. I think, yet again, we come back to the Asia-Pacific market has some slightly different dynamics to Europe and North America, which is driving a lot of the regulatory agenda. And I'd like to bring sort of John Feeney in at this point. I mean, a particular issue, I think, for the Asian market has been that the cross-currency swap is a very major component of Asian derivative markets, yet it's quite complex to clear. This has been a particular problem for the Australian market. And I was just wondering, John, if you could perhaps sort of talk through the CCS issue and whether it's kind of been resolved.
Yeah, the important thing, I think, with CCS is that it's highly unlikely that they're going to be cleared anytime soon, and probably an issue that is common to Australian banks as well as New Zealand and Canadian banks is the sheer amount of cross-currency swap that we have, which supports the bank's issuance into mainly the US market. So we actually have a significant amount of cross-currency swap which won't be cleared in a hurry. That has dominated much of our thought when it comes down to how we would handle an uncleared position and what we might do with initial margin and how we might handle that variation margin-wise. Variation margin's been used on these for many years, so we're reasonably familiar with that. Introduction of initial margin is going to be a much more problematic issue for two reasons. One is that foreign exchange is exempt, and a cross-currency swap is a bit of a mix between a foreign exchange contract and two interest rate contracts. So if you're not careful, you can actually allow a sort of form of regulatory or capital arbitrage if you split up the cross-currency swap into an FX trade, which has one capital and initial margin approach, specifically no initial margin, and one which would actually be incorporated into the new regulation. So we don't want that to happen. So one of the major challenges we have is to make sure that we get an appropriate treatment for cross-currency swaps, both in collateral and initial margin, to ensure that we don't open up this sort of crazy situation where we would have particular swaps that if they're booked in a particular way, actually have a very, very different approach to initial margin of capital. Just I wanted to pick up on one point that Odell made on the initial margin, which I think was maybe a very, very good introduction. Initial margin, as I've just said, particularly for things like cross-currency swaps, having an agreed and standardized calculation is one of the major challenges, because it would seem rather inappropriate if two counterparties calculated an initial margin for the swaps they had between themselves, and you came up with two very, very different numbers. So in other words, two different people posting two different initial margin numbers to each other. And then very, very quickly, you've got to figure out who's going to hold the initial margin. And that's been one of the major problems that we've seen in the market. Calculation of the initial margin, and then secondly, who's going to hold it so that you can achieve this sort of independence or segregation of the initial margin. There are a couple of the major things that we're concentrating on at the moment.
Two excellent points there. So, David, I was wondering if I could bring you on the first of John's points about the issue over calculating initial margin. Perhaps why is it that why isn't a global standard emerged so far with respect to calculating initial margin?
So I think there's several reasons for that. The The original BCBS IOSCO paper gave two methodologies for the calculation of the initial margin. The first was a simple table looking up the notional value with different multiples depending on the product type. So that would be easy to calculate, easy to verify your counterpart's number. But the percentages of notionals that were used were rather high and would lead to very high initial margin amounts. The alternative is a risk-based model, similar to the VAR models that CCPs use for OTC derivatives, but with deliberately a 10-day period of risk, and in order to make the initial margin on non-cleared derivatives at least as high and probably higher than it would be for clearing. So that was deliberate by the regulators to create an incentive to clear, so that there'd be no incentive to keep things on the uncleared side. They also required, in the original documentation, each firm to obtain authorization from the regulator in each jurisdiction in which a model is used. And so as a result of all of that and some technicalities in the way that the IM was calculated, ISDA came up with a proposal called the SIM model, which gave rather more practical suggestions for how initial margin could be carried out. And I think in Asia, the ISDA SIM model has been broadly welcomed, and I've certainly heard one regulator say that they were quite relaxed about the use of the ISDA SIM model. But in Europe and the US, the regulators haven't opined, at least in public, about whether ISDA SIM would be an acceptable calculation basis. So there are now three models. The most practical calculation model, it's not clear whether that'll be acceptable in large parts of the world. And the requirement for each firm to get whatever model they use approved in each jurisdiction. So there's quite a lot of difficulties around modelling. I certainly agree entirely with John. It's a huge problem if it's not possible for one side of the bilateral arrangement to verify the calculation that the other side has done. And if the two sides are working off different models, then there'll be very potentially quite significantly unbalanced IM that goes from one side to the other. So these are, I think, all difficulties with the initial margin calculation.
Okay, but I'd like to bring Kareem in at this point, because obviously from your perspective you're kind of seeing both sides of the kind of sitting in the middle. How is it possible to resolve this issue of two possibly wildly different calculations and three different models? It seems like quite a lot of moving parts. What's the solution?
I don't think that there is a solution that is, out there and obvious to everyone yet. But maybe, I'd like to backtrack a little bit and look at some of the various aspects that have been driven by these drive from regulators. So on one side, I think at the expense of putting a lot of fragmentation, as it was illustrated by all the speakers before me, I think now we're at a point where probably if we look, 2 years or so in the past, even if the situation remains a little bit fragmented and there is a lot of unknown, at least we see that, the marketplace is really moving towards a common goal with regard to implementing what needs to be done for those rules. Definitely, we can't live with different models that cannot be reconciled. We all know the trouble that we all have around dispute resolution and conflict management around those disputes, on a on the bilateral trade basis, if on top of that work you would add some additional disputes for the initial margin, I think that's not going to be sustainable for the market. So in my view, the market has to come with a acceptable model across the board in order for people to be able to find some agreement on the amount of initial margin. I think the next step of complexity is also about some of more the practical and operational aspects. If you think about what is the right holding and segregation model, that has a cost, and it's interestingly, although some of those rules have been promoted by regulators so far, at least from what we see, we haven't seen like a great pickup with regard to market participants to already implement the segregated model. I'm not saying it's a bad model. I'm just saying that probably from the view of some of the market participants, they don't see an immediate need. And they probably have a few questions on how much it costs in order to implement that kind of model. It costs in terms of fees they would pay to providers, but also in terms of the internal administration cost and working resources that they need to put on that. So I think without having a solution, I think we're probably heading towards something which is a little bit more consistent across the market. There are still differences, but at least we can. I think we would probably agree that now most of the regulators in all those jurisdictions are moving in the same direction, at least more than before.
Karim, I'm going to put you on the spot. We have three separate models, and which is VHS and which is Betamax. Which of these models is going to become the dominant? Is it going to be ISDA? Is that going to be the dominant model?
I think the fact that as the ISDA as an industry association comes up with a model, my own personal view is that it probably has good chances to be adopted because a lot of people are putting brain power into the model and make sure that it is acceptable to the wider community. The first model, the one that was, very simple and mechanic by applying a certain amount of percentage on specific trade types, it's simple, but it's expensive from the perspective on how much margin you need to put you need to put up. So, and I think the other model, which is everyone can get their model approved, and people who are very concerned about capital costs will probably have very efficient model, but do they really want to put it out there and potentially share it with their counterpart? I mean, if they're efficient, they don't necessarily want to share these very personal and specific information that they have about their firm. So, I think if the market comes, and it can be ISDA, or at least the only contender today that we really see is ISDA, if the market comes up with a good compromise, that's the one that is going to win.
Okay. I'd like to bring Nick Horn at this point. Obviously, as an end user of OTC derivatives, as the end user of these types of derivatives, what's the impact on you? And in terms of, you've got a multiplicity of models, it's not clear to perhaps how your counterparties are coming up with some of their IM figures, etc., etc. How significant a problem is that for you? And do you see this as potentially changing your approach to use of derivatives unless the modelling issue is resolved?
Thanks, Aaron, because I was about to comment anyway. I think one thing to add into this is I agree with points made before that there'll probably be a little bit of coyness in regards to people wanting to give away all their secrets. So I imagine that there will be something along the lines of the ISDA model, which, as long as the end result can be reconciled to within a certain amount, I think there's going to be a little bit of latitude which is left with minimum transfer amounts, or just some kind of ability for a tri-party agreement on, I wouldn't call this a dispute, but maybe more of a disagreement on what the exact numbers should be. Because I think one of the missing pieces of this argument thus far is the fact that you are now potentially dealing with bespoke trades which nobody's going to agree a valuation on in the first place. So you've got not only got the issue with what should the initial margin model look like based on some of the inputs to that and the dynamics of the particular trade, but you're also going to have disputes in regards to on the variation margin front as well, in regards to what that actual trade is worth. So it does cause issues. Yeah, is it an issue for us? Absolutely. But I think it's rather than dwelling too much on the geekery around how we will arrive at the same number, I think what the bigger thing to be worried about in the immediate term is the huge task of getting to the point where we can even agree how we arrive on methodologies for having legal agreements on such things, valuation processes, as I said, dispute resolution, custodianship of these trades and the variation margins which come with them, the reporting, the reconciliation, and on top of that, because this is a much bigger, badder problem than or task, than getting ready for clearing trades. It's you're collecting the operational capability of potentially some participants who have sidestepped or not yet even addressed the far more gentlemanly conduct, which is around trading with a counterparty where on an exchange where valuation is known, that margin calls are made for you, and all you need to do is volunteer the number that's asked for. It's a much bigger uplift. So that's a view I just wanted to put across in regards to the scale of the issue at hand here.
Nick, it's John. One of the things that I think is really important in all of this is there's different motivations for different participants in the market. That's really an extension of what you were sort of saying there. I mean, ultimately for the banking sector, the motivation is very clearly early take-up based on capital use. So clarity from each of our regulators as to what their approach will be, and if it is as per BCBS, then that's pretty simple. If we go down that path, then the banks are generally motivated because of capital constraints, or indeed a trade-off between the additional cost versus the capital release of doing it. On the other side, if the buy side, or perhaps the people who are less inclined to have initial margin relationships with each other, or indeed clearing through a CCP, then that will have to be ultimately reflected in the price. So
absolutely.
So the motivation on the kind of non-IM side is really one of, is the price more than my cost of being involved, or is it less? Because they're usually not motivated by the capital argument, because they're just ruled from a different, their capital position is done very, very differently to that of a bank. So just two things at play.
Well, I want to take about that pricing point. So you're expecting there's going to be a significant change in pricing as a result of this, between whether people are able to provide the IM or not?
Well, if you accept the fact that there's a difference between pricing for a cleared trade and a non-cleared trade, which there evidently is, then that will be extended to those with or without IM.
Aaron, just to expand on that, I was going to say to agree with John on that in regards to what the problem, which unfortunately the industry is just not aware of yet, is that exemption from these rules, or being given a greater period of time to not necessarily comply with transferring margin. That's all fine, but my view, as John's pointed out, is ultimately you'll need to pay for it. That's fine. You can choose not to post collateral, but you'll ultimately be paying for it. So when you asked me, your original question was how could this change our potential derivatives trading strategy, even if we are not necessarily captured, or one of our clients is not necessarily captured, we certainly could change how we actually transact with other banks, because it will come with a commercial incentive to do something. So you can sit by the sidelines, but you'll be paying for it.
I think...
I was just going to bring Cream and Odell in at this point. Perhaps I can come to you a sec, though. I was interested from your clients, your end clients. Have you noticed this kind of change in behaviour? What are they telling you in terms of how this is going to impact the way they approach their business?
I guess two comments on that. Just pick up on the point regarding the commercials are going to sort of dictate which direction they go. So if all things are equal and, especially from a buy-side perspective, a client has an exemption in terms of, central clearing and opt to do it, in terms of a non-cleared environment, they are going to be evaluating what is the cost with respect to their counterparty to actually do that trade. And if the cost is such that it becomes prohibitive or it's significantly more expensive to do that trade as a non-clear trade, then they would consider or opt for the option where they clear it on an exchange. So I think that's a critical component. In terms of the other sort of observation we see from clients, they are interested and quite inquisitive in terms of understanding, the dynamics from a operational perspective. So yes, the commercial aspect is a consideration, but also just the simple question are, how am I going to manage this? Across my several different counterparties from a non-cleared standpoint, or in the case where they do have cleared trades, what is going to be the operational arrangement? And when you look at it from a volume perspective, that's probably, one of the key aspects in terms of determining whether or not they're going to try to manage this internally or, employ a group or a team to actually focus on this, as opposed to, coming out to the broader marketplace where they look at support from a third-party type of agent.
David, can I bring you in on this point?
Yes, I think that the whole discussion around incentives is very interesting, and there are some sort of counterintuitive incentives at work across the whole piece. A couple that I could mention, we said earlier that if you calculate initial margin off the schedule, you'll come up with a very much higher initial margin model compared to if you higher amount of initial margin compared to using the model. But the beneficiary of that isn't balanced properly, because if you've got two counterparties and one uses the schedule and the other uses the model, then the guy using the schedule will receive the high level of initial margin from the guy using the model. So by using a model, it means that your counterparty benefits, not necessarily you. So that's one sort of incentive that appears to be the wrong way round. Another one is during the transition phase, the first phase of initial margin affects only the largest firms with more than 3 trillion notional in derivatives exposures. So those firms have to start exchanging initial margin with each other, but they don't have to exchange initial margin with the rest of the market, which will create an incentive along exactly the same lines as we've just been discussing to either move things into clearing, which is what the regulators want, or for those large firms to trade less with each other and more with firms that are not yet required to call initial margin. If a large firm trades with a smaller firm, then there's no initial margin either way, so they're in the same regime as they are at the moment. So the incentives don't necessarily drive the behavior that the regulator is looking for.
Hi, it's John. There is one other angle to that one, and that is the fear of missing out. So in other words, if liquidity shifts, and liquidity is largely governed by the people who will be in that first round anyway, so that's the 3 trillion club and above. If they're the ones providing the liquidity to the market, anybody who has need to access that liquidity, almost by definition, needs to get involved sooner rather than later. So I kind of see the incentive certainly from the interbank participant side to become involved as being driven more by need for both liquidity and capital relief than it would be through any mandate that would be put upon them by being above that 3 trillion level. So much like what we've seen with clearing, in many cases people actually opted in rather than being mandated, well before being mandated to do it, simply because that's where the liquidity shifted. And that's certainly something that we see, and certainly something that I would expect sometime coming up to September 2016.
Yes, I agree with that. But
so can I just bring Kareem in at this point? So, Kareem, from your perspective, I mean, do you agree with John's point there? I mean, is that scenario realistic?
Yeah, I think most of the points that have been expressed just before, I tend to agree. I think if I look the various behaviors and try to put them in broad categories, I think there is a very small minority of market participants who are still trying to navigate in between exemptions, delays, and try to escape. But I don't think it's useful to comment on those ones for too long. I think the vast majority of the market participants, exactly as the point made on the ones who have decided to opt in clearing, have got a pretty good idea of what they want to do with regard to collateral management. So they figured out that something needs to be done. They have an idea about the amount of work, what are the practicalities, whether they have identified whether they have issues in order to manage that operationally, and then they have a course of action. They may not have taken the decision, but they have in front of them all of the options. And then you have, I would say, the more sophisticated ones who are then looking to the next step in the thinking and look at probably what's the cost perspective and how the cost is going to impact the performance of their investment. And that's where, in fact, the discussion becomes really interesting, and that's where you see that people are looking forward and, deciding on top of these basic, more operational questions around collateral management, whether they're going to rebalance between what they currently clear, what they could be clearing, what is going to remain bilateral because there is no clearing venue for it, and then get into the questions around what kind of model they're going to apply with regard to margining, initial margins, as well as collateral management. And then the discussions get even more interesting around getting to consolidate these aspects of collateral management across various type of activities that requires margining. So obviously you've got cleared and non-cleared activity, but we got everything that relates to financing, repo, securities lending, which comes under the roof of centralized collateral management.
And so, David, can I bring you in at this point? Because I think that's a very interesting point that Kareem mentions there. Obviously, there's a multiplicity of demands on collateral, and in some respects, this is just the latest of many. How do you kind of opt? What are the solutions to the issue that he was talking about there in terms of managing these manifold collateral requirements?
Well, I think that's right, and generally over the last years, there's been collateral has become more important in financial firms of all types, and we've seen considerable development in collateral management. Central counterparties have improved their handling of collateral and their efficiency. Central banks have. FCMs and sell-side firms have, and buy-side firms are in the process of doing it. And it is this idea of centralizing collateral, of improving systems, improving the measures of risk around collateral, getting a high level of automation and STP, and looking forward to an era of optimization and inventory balancing, high-speed hubs and highways that are being created by custodian networks, and being able to turn on a sixpence, really. When the economic conditions change, you want to be able to move between cash or non-cash collateral where you can. So there have been lots of developments, and the art of collateral management has improved considerably, and will continue to do so.
Yeah, there's a very interesting. Sorry, there's a really interesting question that came in before, which I think relates very much to that, to David's statement there, and that is that it's not just the amount of collateral, but it's the variety of collateral. So the question from that we had earlier was that of North American and European counterparties' reluctance to accept Asian bonds, for instance. as is well documented, there is a bit of a lack of collateral running around the market. And so one of the challenges for the market is how do you convert or change collateral that may be acceptable for one person but not necessarily for another into something which is acceptable. That is an ongoing challenge for the market, because we are going to run out of acceptable collateral, or put it this way, traditionally acceptable collateral, in the not too distant future.
Well, fortunately, we're very blessed in having two collateral management experts sat in the room here. So, Odell, would you like to take that question? I mean, I'm sure you have the answer at your fingertips.
Yeah, I mean, it's sort of one of the points that I touched on earlier on, and Kareem sort of brought it up again. I mean, the reality is exactly what has been described in terms of looking at IM or looking at OTC derivative in terms of clear and non-clear, and the collateral requirements around that is just one component of a broader space of activity that's taking place. So in terms of the specific answer, I wouldn't say specific answer, but some of the consideration that we see out there, and especially from a buy-side client perspective, it's actually twofold. One, it's an opportunity, which I'll expand in a second, and the second bit is the liquidity challenge, which all of us are familiar with. How do you get the right type of collateral to the respective counterparty? Where it's an opportunity is that some of these same buy-side clients, they tend to have long position of high-quality collateral, whether it's G4 type of currency or G4 type of government securities. So to the extent that they have those positions available, this is an opportunity that they can use through secure financing trade, whether it's a repo or an upgrade trade as far as a stock loan transaction, to get the benefit commercially in terms of doing those trades, and also satisfy the demand from the broader marketplace in terms of those participants out there that is looking for high quality collateral. So I think there's going to be a bit of a mix in terms of one, trying to figure out the challenge around the liquidity, but at the same time in the inventory, the asset inventory space, where you have assets that are not readily qualified to satisfy those obligations, looking for other upgrade opportunities from respective market counterparts to actually satisfy that obligation.
We have someone from the buy side on the phone. Nick, I was wondering if you could sort of take Odell's points there about your long high quality collateral. Is this an opportunity rather than a challenge for you, this environment?
You certainly should view it that way, and it's something that we look at. And also, you've got to remember, we manage money for our clients rather than our own proprietary fund. So certainly there are clients that are interested in getting more out of their cash reserves. So there's certainly opportunity there, but again, it's something I think does make sense, but it's the reintroduction of potential counterparty risk and your own liquidity risk when you start getting into these things and wonder what the world would look like when 3 or 4 legs need to be unwound very quickly, and it's actually you who had the original liquidity wants that back, or the higher quality collateral. But it certainly is a potential issue, and one of the other things I should mention, just as an aside from the buy side, is where you're trading globally, as we are, liquidity management can become quite an inefficient exercise, where you can choose to manage liquidity in one big pool via one currency, and then use your counterparties to potentially transform that into whatever currency you want to be posted, or you could potentially try and do it more efficiently yourself, and hold liquidity pools in appropriate currencies to be posted out as you see fit. But again, we're very much at the contemplation phase as to whether that would be costly or complicated and potentially inefficient. So I think to go beyond saying that it's something that we're trying to figure out is a bit of a stretch, because it's almost like the game within the game, which still hasn't started yet.
Okay.
Yeah, some of the options that we see on the table at the moment, when clients are weighing between opportunities they can make out of collateral transformation, I mean, the alternative from a liquidity perspective is for those clients to just maintain some high quality collateral or cash buffers to be able to respond to margin calls, whether initial margin and variation margin. But as they figure out the increase, the expected increase in the amount of collateral, then they start to factor in the drag on the performance, because these high-quality assets or cash is not going to provide the same yield as if they were investing in high-yield bonds or equities. So they're running the numbers, and then they realize how much is going to impact the performance, and then finally they probably come back to reconsider eventually going into collateral transformation. And there will be a market for everything, so people are going to choose based on the economics and within the guidelines that, of course, they are following with regard to investor protection as well as investment directive, for instance.
I just want to pick up on.
Sorry, Aaron. I was just going to say that I think that's a fair comment, but one of the other things to add on to that, the idea of collateral management is moved beyond, I think, the one dimension of think about what is cheapest to deliver. The first mindset is what is the most deliverable at the broadest range of counterparties or exchanges that you need to deal with. So it's less about managing the immediate cost. It's managing the contingency of if there is some issue, how many different directions can I post what I'm holding.
And I think there's also a very interesting point there about what constitutes kind of high quality assets. And as one of the questions we had earlier points out, the reluctance of certain North American and European candidates, counterparties, to accept some Asian collateral. Yet by the same token, Singapore dollar, Hong Kong dollar, two very obvious examples. You've got quite a lot of reserves of high quality Asian collateral. From actually perhaps to the collateral guys with me in Hong Kong, have you seen much of a difference in kind of attitude in terms of the counterparties, the types of collateral that people will accept? Are people becoming more open-minded towards perhaps taking high-grade Asian collateral?
Yeah, so if I could take that, if you look at trading activity around derivative type of contracts, what we see, and there hasn't been a material change around this, is predominantly cash being used as collateral, and that covers north of like 80% of the type of collateral that you see. In terms of non-cash, it will be sovereign type of securities that you see as collateral. You see hardly any move into like the corporate bond space, much less even the equity space. In terms of like specific markets, if you sort of move out of the derivative trading space and you look more in terms of collateral from like a financing perspective, we do see a pickup in terms of the Asian market. We see a lot of pickup in terms of Japan specifically. We do see similar trends in Australia. Hong Kong, and we are seeing some of the North Asian markets like Taiwan and Korea, where there is that demand in terms of using that type of inventory as collateral. But for the last couple of markets that I just mentioned, I wouldn't say there's a sea change or a wave in terms of you see a high usage of those type of securities for those specific markets. But we do see some promising signs for Japan and Australia.
Okay, Kareem, do you have anything to add?
Yeah, I also definitely agree with that. I think we see a little bit of a take-up for Asian collateral. I think we have some examples, mostly insurance companies, when they are incorporated in a given market, they are bound to hold the local currency, the local government bond, and as a result, they're naturally long of that, and they would like to use that as collateral with their counterparts. So definitely that happens in Singapore. I think we've seen a little bit in Thailand. Korea is also interesting because of Korean players being bound to use Korean government bonds as collateral under a specific pledge structure, which is used locally. So indeed, our pocket of opportunities for widening the collateral. But still, generally, I think the collateral remains pretty standard. I think an important question also is about, in many cases, the base currency of the trade is going to be, and the valuation as a result is going to be US dollars, and as a result, there are going to be a foreign exchange haircut when collateral is denominated in another currency. And then depending on, the credit appetite, that the haircut can be quite significant. So I think the client will be balanced between using collateral that they have readily have available with a high haircut, which to an extreme can be seen as an unsecured exposure taken by the collateral giver to the other party because they largely over-collateralize, as opposed to provide collateral which is more standard at a more reasonable haircut, which then doesn't create that kind of, reverse counterparty risk, if I can call it that way.
Okay, David, I was wondering if I could. I think I quite like that reverse counterparty risk coming there from recruitment. I was wondering from your perspective. I mean, how do you see the industry dealing with that issue?
Well, we haven't really seen the cross-currency haircuts come in yet, but I think they're going to certainly concentrate minds and drive behaviour a bit. The other effect that you've got as far as Asian securities usable as collateral is across Asia you've got a lot of regional clearing houses, Hong Kong, Singapore, Australia, Japan and so on, and so those clearing houses will typically accept Asian securities, whereas the big international clearing houses in Europe and America tend more to prefer European government bonds and Americans and gilts and so on. So we see that difference. The cross-currency haircuts are going to come in with the variation margin requirements, which are not phased. They're going to affect all market participants with substantial portfolios over 8 billion from September 2016. And they're going to drive quite a fragmentation. There's going to be a huge increase in the number of margin calls because to avoid the FX haircuts, people will collateralize in the currency of the exposure, which will cause a multiplication in the number of variation margin calls. So if you've got exposures across 3 or 4 currencies, you'll have 3 or 4 margin calls each day. But that will then get doubled during the transition period because you'll have the opportunity not to apply that for legacy trades that were started before the September 2016 deadline. So your 3 or 4 margin calls might become 6 or 8 margin calls per day. The FX haircuts are sitting at 8%, so there's quite a big penalty for not going down the route of VM currency silos. So it'll be interesting to see how that develops. And the impacts are not only in processing the number of margin calls, it's also in managing the liquidity, in managing all the paperwork of ISDA documentation and updating your systems. If your systems have to hold 8 times as many margin call agreements, then you've got quite a systems burden as well as a operational and legal burden. So the variation margin requirements are a little more tricky than they appear at first sight, I think.
Could I add a pricing element to that one, if that's okay, Aaron? It's John. Because being a practitioner in this one from a front office perspective, it gives us a very different kind of approach to this type of thing. So variation margin and initial margin are 2 completely different things from our perspective. First of all, if you clear something, it's very, very obvious and it's prescribed which currency and how you can actually provide your variation margin. It is in the currency of the underlying trade, no choice. However, in the case of CSAs, there's actually considerable choice, which brings into play the cheapest to deliver optionality for the person providing the collateral. So often, if you have a look at, say, for instance, dollar exposure collateralized with yen as currency, there's a massive basis swap between the two, running in the favour of providing yen as the collateral of 30-odd, 50-odd basis points, depending on which, when you look at it. So there's a massive incentive for the provider of the collateral to reach for the cheapest to deliver from a variation margin point of view. And indeed, that's priced into the deals when we do them. Okay, so outside of clearing, when you have this option, it's got to be priced in. And so often when you're getting collateral, you're getting the cheapest to deliver because that's the natural and commercial approach taken by your counterparty. Initial margin is completely different. First of all, it's held by a third party, so you don't exchange it with each other. And the second thing is that that's often done in the form of securities. And remember, the initial margin doesn't relate to an individual deal. It's only related to the overall portfolio, and therefore you don't have the pricing approach that you would take with the variation margin. So not only do you have the complication of people giving you currency that's outside the underlying exposure currency, it's overlaid with a pricing decision based on how cheap it is to deliver that.
And what's the resolution to that in terms of you've got these two issues? What's the solution?
I think David mentioned it a minute ago. I mean, having more standardised CSAs, which ISDA is trying to promote, I must say with some difficulty, but standardising the CSAs means that you remove at least some of that optionality, and that actually makes for an awful lot easier decision with regard to this sort of thing, and starts to limit the number of types of currency or types of collateral that you can receive, thereby simplifying your calculations for one, and your process secondly.
Nick, can I sort of bring you in this point? I mean, you share that view, the kind of the standardised CSA. I mean, is that the way forward?
I think it would be handy. Again, with us right now, we're quite lucky that we almost ubiquitously post cash, but I don't think in a world where a lot more is cleared and a lot more is margin where it isn't cleared, I think that's something which is going to be revised or just might not be possible, and it's certainly going to be less efficient. So where we can best execution is a key thing for us as well. So where you make it more sensible and consistent for us to apply these things across our business and across clients, I don't see that being a bad thing.
Okay, and Nick, from your perspective, I mean, do you agree that the kind of well, I actually want to move on to the issue of the kind of the segregation and where the assets sit. Is the segregation issue a significant one for you?
Yeah, it's a real tough one for us in that one of the key things we have is being able to bring our clients along for the ride, because they're a bit further. So we're talking about some superannuation and pension funds, and even private, large, private pools of funds. To take a step back on in terms of the landscape that we're playing on here, you have to remember that in Australia, the CIS Act, which basically oversees what we can and can't do, or what superannuation funds can and can't do with their money, we're actually still not technically allowed to post on behalf of a superannuation fund any margin collateral to back a swap. So that doesn't matter whether it's cleared or uncleared. So the backlog of regulatory reform, which needs to be, this is more of a tick box exercise, but it paints the right picture of, the world is trying to do a lot of things that local regulators haven't even been able to fully facilitate. So going back to segregation, so with us, if we start saying to our superannuation clients, we want to post assets, we need to clearly explain to them what the different options are. So let's just talk about posting things on an omnibus account, similar to futures, versus something which might be in the LASOC style, so legally segregated, operationally commingled, which for all intents and purposes looks as though it's segregated, but still does have that potential cross client risk. And then you have the full segregation amount model. If we had that simple conversation right now, almost everybody would say, well, of course I would like my money separate to someone else, and I'd like someone to take a photo of themselves with today's newspaper next to my particular stash of collateral. But all that comes at a cost, and that cost is not yet quantifiable, either in terms of the custodian or clearinghouse that is facilitating those options. The actual functionality of those things isn't really bedded down. It's certainly not consistent. I'm just thinking about clearing now as well, across clearinghouses who are attempting to make it obvious that they have some kind of commercial edge and can make your money safer than somewhere else, or more mobile than someone else, despite being in its own little pigeonhole. It's something that we would absolutely be happy to deal with, but it's hard to price up, both internally in terms of operational complexity, and also externally the cost imposed by clearinghouses, custodians, or clearing brokers. It's very, very hard.
Del?
Yeah, I think from the segregation perspective, looking at it from a collateral agent standpoint, with respect to non-cash, when you look at it from a securities perspective, providing that level of segregation, both from an operational and from a legal standpoint, that's something that, when I look at, the client base, that demand is out there. But as was mentioned before, that's balanced by the cost in terms of actually utilizing that service, right? I think from a operational and a best practice perspective, I think, everyone will be much more comfortable having that level of segregation. When you look at it from a cash perspective, even though you can have your segregated cash accounts and so on, just because of the fungibility or the fungible nature of cash, I think operationally that still presents a challenge. Or when you look at it from a balance sheet perspective and the risk that is involved, that is still a challenge that is going to still be out there. I think there is probably more hope, or the evolution in terms of getting to a segregated or even a fully segregated model is probably easy to achieve on the security or non-cash front. On the cash front, other than having the account segregated, I think we're probably going to have a little bit more distance to go to get there.
Okay, thank you. Well, I think we've had we're virtually at the end of the discussion. I think we've covered quite a lot of ground, both in terms of the various modelling approaches and also the variety of segregation, and also the issue of kind of collateral and what constitutes available collateral, and how you do the kind of collateral upgrade approach. I want to sort of give the final word to David. Obviously, there's been an extension to the deadline, but there are still several deadlines ahead for this issue. I mean, in terms from an end user, from your perspective, what do end users need to do to kind of get on top of this issue? What should the priority list be?
Well, yes, we've covered a lot of ground, and each of the topics that we've spoken about, we could easily have spent 2 or 3 times the amount of time discussing. I think the conclusion is that the impacts are profound across variation margin and initial margin. The ripples go out into the repo and sec lending world. The whole of collateral management is affected by these changes as they roll out, and the impacts are legal and operational, as well as front office and risk, and they affect the client service aspects as well as the house aspects. Our belief in Calypso is that you need sophisticated systems that are looking across all of these aspects, from front office pricing all the way through the phases of both cleared and non-cleared collateral management, into the delivery and segregation models, and that managing collateral becomes part of managing cash and liquidity. And a sophisticated collateral management needs to be able to tap into things like repo and sec lending worlds in order to achieve transformation objectives. Needs to be able to respond in real time to the real-time needs of clearinghouses, and still support different operational processes required by counterparties that are at different stages of evolution down this phased implementation.
Okay, thank you, David. Well, that brings us to the end of our webinar. I'd like to have a big thank you to our panelists, particularly the gentleman who dialed in late in the evening from Australia. I appreciate you giving your time for us for this conversation, and I hope you, the listeners, have found this a useful discussion. Once again, thank you very much for listening, and I look forward to discussing the next issue with you in a couple of months' time. Thank you.